Hey guys, it is Julie here with TipRanks. In today's video, we're taking a look at two stocks that both went through SPAC mergers this past year and have cooled off since. But analysts that have recently taken a look think they have some big room to grow in the future. So let's get into it. Alright guys, welcome back and thank you so much for being here. Like I said, the two companies we're looking at today both made their debut on the public market via a reverse merger with a blank check company. Now, SPACs have cooled off a lot this past year compared to the phenomenon that was happening back in 2020, but there's still some great companies coming to the market via these reverse mergers. So we're going to take a look at these two companies and why analysts are rating them both strong buys with some pretty serious double-digit upside. Just before we get into that, this is your friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Okay, let's get right into these two companies. The first one we're starting off with is a company called Hyzon. Hyzon trades under the ticker HYZN and are currently priced at $10.52 per share. Hyzon was established as a new business of Horizon Fuel Cell. They are a global supplier of zero-emissions hydrogen fuel cell powered commercial vehicles, including heavy-duty trucks, buses, and coaches. Hyzon commercializes Horizon's 17-plus years of hydrogen technology and development for the transport sector. Its establishment as a standalone entity was to focus on accelerating the energy transition through the manufacturing and supply of hydrogen fuel cell-powered commercial vehicles across the North American, European, and Australian regions. Hyzon was known as the Heavy Vehicle Business Unit of Horizon and was responsible for the development of fuel cell systems and the delivery of about 500 fuel cell-powered commercial vehicles during 2019 and 2020, leveraging the deep and extensive experience bolstered within the group. Hyzon has a robust pipeline with a high number of future orders under MOU or Memorandum of Understanding. They have $55 million of revenue under contract in the near term or under MOU already, and it grows to $150 million if they include their high probability customers. For the longer term, they're projecting $3.3 billion by 2025 in revenue pipeline. The company is targeting the achievement of 3 key milestones in 2021. The first milestone is the vehicle production being underway in the US and Europe. Number 2 is commissioning US fuel cell manufacturing by building Rochester into a fully functional plant producing fuel cells to deliver to Hyzon, and expecting to celebrate the 85th vehicle being deployed before the end of 2021. They recently signed an MOU to supply up to 500 hydrogen fuel cell electric vehicles to a Shanghai logistics company. This was with the Shanghai Hydrogen Hongyang Automotive Company. Under the non-binding MOU, the initial order of 100 vehicles is expected to come in before the end of 2021, while the other 400 vehicles will be ordered in 2022. Back on August 11th, Hyzon shared their second quarter earnings results. For their second quarter, the company reported total operating expenses of $9.3 million and a net loss attributable to Hyzon of $9.4 million, resulting in a net loss of 10 cents per share. Some of the highlights from their second quarter included delivering the first Hyzon fuel cell electric trucks back in July to customers over in Europe, expanding their orders and MOUs from $40 million to $83 million with additional customer uptake in Europe and Australia, and investing $2.5 million in Raven SR, securing negative carbon score hydrogen supply options from 250 hubs. They ended up with $517 million cash on hand as of August 10th as well. Weighing in on the stock is 5-star analyst Daniel Ives from Wedbush. He said that we are starting to see a number of pilot projects globally and increased activity around the use of hydrogen for the long-haul trucking industry, and ultimately believe that Hyzon is quickly establishing itself as the clear leader in this key market opportunity. Hyzon's unique hydrogen fuel cell and production intellectual property, paired with the dynamic potential of hydrogen, serves as a driving force to their success. There are 4 analysts altogether with current ratings on the Hyzon stock, and they all come in with buy ratings. The average price target of $19 would be an upside potential of 80%. Daniel Ives' price target of $15 is on the low end, which is still a 41% upside, and on the high end we have a $22 price target, which would be growth potential of 107%. For our second company today, we're moving over to the real estate world with Doma Holdings. Trading under the ticker DOMA, they're currently priced at $7.13 per share. Doma enables real estate professionals, lenders, and title agents to close real estate transactions that are faster, more accurate, and more affordable for home buyers. Nowadays, consumers expect instant digital experiences, and residential real estate is just now joining this revolution. Closing on a home today combines a process from the 1890s with technology from the 1990s, a recipe that fails to remove the burdensome procedures, reams of paper, and extreme frustration inherent to closing a mortgage. Doma is changing that. With their Doma Title, Doma Escrow, and Doma Close, they are taking processes that used to take 3 to 5 days down to a minute, and processes from 30 to 50 days down to just a week. Their Doma Intelligence replaces large portions of the title and closing process with a data science technology. Their Doma Title is instant, and their escrow has removed 15 steps, while their closing process has removed 10. They're currently licensed in about 15 different states and are targeting to be licensed in nearly all states besides Iowa, by the end of 2023. Doma just completed their SPAC merger in July of this summer, and shortly after that, at the beginning of August, they shared their second quarter earnings results, plus raised their future guidance. Their total revenues came in at $130 million, which was up 29% year over year. Their closed orders were up 44%, and their adjusted gross profit of $30 million was up 31% year over year. They're now expecting 2021 gross profit between $83 million and $93 million, and adjusted gross profit between $95 to $105 million, up from $89 million. One analyst that just initiated coverage on the Doma stock a few days ago is five-star analyst Nicholas Jones from Citigroup. He says that Doma is a disruptive title insurance company leveraging proprietary algorithms to underwrite title insurance premiums nearly instantly. The analyst sees opportunity for Doma to continue winning share, particularly at lenders. Nicholas is one of 3 analysts that currently have a rating on the Doma stock, and once again we have unanimous buy ratings. Their average price target comes in at $13.33, which would be an upside potential of nearly 87%. Nicholas's price target of $11 is on the low end, with still a 47% upside, and on the high end, a $15 price target, which would be growth of 101%. So some big upside for these 2 previous SPAC companies that have now completed their mergers. I'd love to hear from you guys what you think on these 2 companies in the comments down below, so let me know your thoughts. As always, these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes, so please make sure you're always doing your own research and due diligence before making any investment decision. If you made it to the end of today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Thank you guys so much for watching, and I'll see you back here next time.